Hi, everyone, and welcome to the webinar, which is all about the statement of advice. And we're looking at the part of the stage where you've completed the statement of advice online and you're wondering what it actually means, or you're finding that there's different parts about it that you need more explanation on. This is the webinar and it's designed just for you. I'm Tom Wilson. I'm the investor educator at InvestSMART, and let's get you through the statement of advice. So what we'll cover today is we'll understand what's actually inside the statement of advice. We'll break down your investment plan that's been put forward to you in that advice. And we'll look at some other common questions, particularly around fees and how InvestSMART manages your money. And lastly, we'll have a look at how to actually take the next step and put your plan into action. Now, just as always, the disclaimer and general advice warning. So we provide general product advice here, general financial advice at InvestSMART. We don't provide any personalized financial advice. And that's very important because the statement of advice that you've received is what's called a limited statement of advice. And I'll show you exactly what that means, but it's just going to cover off the InvestSMART authorized product list, or approved product list, I should say. And a lot of that is written inside the statement of advice for you. That just means that there are other products out there, but that statement of advice that we've done with you, it doesn't cover other products that are out there in the market. So you would have done the quiz, and if not, it's very easy to do, and you can do multiple statement of advice quizzes. So you can actually go over it and come up with different goals, different plans, which most of us do have. So we've done that, which is fantastic. And the next part is actually receiving the statement of advice. So we would have gotten an online confirmation, taken us to a screen, and it would have shown us different portfolios or different risk profiles that match to us and our time frame and our goal. And the actual paper copy is emailed to you, and that puts everything into stone for you, so to speak. They're valid for about a good month, and anytime after that, you should probably go back and just redo it. And if you do go ahead and invest, you should try and look at doing one every 12 months. And that's all written inside the statement of advice as well. They're also saved onto the dashboard inside InvestSMART, but I'll show you where everything is. Because what I'll do now is I'll actually show you one that I've prepared earlier. What you can see here is obviously the front page of my screen, talking about it's been prepared for me, runs through the contents, obviously. And here we've got just a general outline talking about why this advice is limited. And you can see that there it says that they only recommend, or we only recommend products that are from our own list. So that's what it means by limited advice. And the other thing is too, you're more than welcome to ask questions as we go through the webinar. We got a couple of questions before we actually started during the registration phase, but you can always ask questions later. There's going to be a part at the end you can do that, or you can always email us with any follow-up questions. But I'll keep on tracking through because there is a bit to get through inside this. Now, this is what I'm talking about with the scope of our advice. So this is our approved product list, and that's the limited part. So it's basically giving you our product range to choose from. It doesn't talk about other investments that may be suitable for you as well. I'll talk quickly about why we do think our products are good. Obviously, they're individual accounts, and we use this term, which is written just here for us, professionally managed account. So it's an account that's set up in your name or in the entity that you open it up in, because you can do different account types. You can do individual or joint, so two people. You can do family trusts, discretionary trusts. You can do companies. You can also do SMSFs. You can also do children's accounts, so you can open up in trust for a child. The best thing about the individual accounts, what it means is that we literally open up a brokerage account, a share brokerage account with you, for you, in your name. So it's all held in your name. So if something were to happen to InvestSMART, it means that all your investments are safe, and that wouldn't affect it. It also is very handy when it comes to the capital gains aspect. Normally in a pooled fund, like a managed fund, all the money gets pulled together. You buy a unit in that actual fund. And then in order to leave that investment, you have to sell that unit back to whatever the price is. And that could generate a capital tax event, capital gain or a capital loss. With the actual InvestSMART PMA, with our accounts, if you ever decided to, in the future, perhaps you've got time, you retire and you want to do this yourself, you can transfer from your brokerage account with us into your own brokerage account, and that won't have any capital gain or capital loss. You're simply moving it from one to the other. So that's a very handy feature. Now, I'll go through the other thing that makes us perhaps unique in this field is that we have a capped management fee. So the management fee that we charge to actually look after your investment, look after your portfolio is capped. So up to $100,000 invested, we charge 0.55% per annum. So that's like $55 per year on every $10,000. And above that, if you've got more than 100,000, so on $100,000, that would work out to be $550 per year. But if you've got $200,000, that's over the cap. So it means that your fee is actually going to be $550 per year. If you've got $1 million, it's still only $550 per year. So that's one of the benefits that we have here at InvestSMART, and it's quite unique. It makes it quite popular. We go through and talk about what we actually didn't ask you inside the statement of advice quiz, what we actually don't cover. So that's important too, just to be aware of that. So what do they know about me? They know my name, my age group, they know my experience, and they give me some more warnings here as well, which is important to read. But this is the part where we get to where it's actually going to help me now understand my financial goal. So most people, they don't tend to do this part. They tend to not plan whatsoever. It's a fantastic way to actually help you put pen to paper, so to speak, because the people that actually plan, they will outperform those who don't have a plan whatsoever. So I made up a goal. I just said my first home, and they're saying that I require $120,000. So that's the very important part, because it's saying what my target is. And I said that I've got 3 years in which I can do this. The inflation, it's an estimate. You can always change this inside the quiz. It's 2.5%. And that's important because by the time the 3-year period is up, that $129 in real terms will be worth $129,000. So it means that I need to just make sure that when I get there, I've adjusted for inflation. So it goes through, it shows me a graph, fairly straightforward, very straight line, if only life and investing was a straight line, which it isn't. But you can see here that financial goal, 120, I said I can start with 93,000. So I've squirreled away 93,000 so far. 3 years is my time frame. I've also said I can contribute $600 per month. That puts me, because of the time frame I've chosen, now 3 years is actually a fairly short time when it comes to investing, conservative. So that's the risk profile that's been attached to the answers that I've answered in the quiz. We've spoken about the inflation. It's talking here about the goal time frame now. So it's talking about your time frame needs to be 3 years. And because of that, it means that I'm a conservative risk profile. I'm talking about the monthly contributions that I said I can make. And it talks about dollar cost averaging, which is a very interesting concept. And we do talk about that on the website. There's also a course we've got called InvestSMART Bootcamp, and you can join that from the menu at the very top of the website. So here I'm saying I've got $93,000, and it's using our portfolio manager tool, which you can always do yourself. You can go in and actually add your existing assets and give it a very clear-cut idea of where you stand. In my case, I just went through the statement of advice tool, and I've just told it I've got $93,000 in cash. So it's saying, Tom, you've got 100% in the cash asset allocation. So that's not a problem. I'm going to go down a bit further now, and just they'll explain the basis of this advice on how it works. Now, obviously it goes through and talks about how investing, there's always a risk with investing. Even when you put your money into the bank account, that still does carry a risk, even though it's called risk-free in some instances. And what I mean by that is if you're locked into some kind of interest rate, there could be the interest rate risk where you're locked into something and there's a higher rate being paid. There's also the risk that the bank could fail. Even though in Australia we've got certain schemes in place that can help us, but it's not entirely devoid of risk. But you can see here that if I had just left it in cash, it would be a fairly low risk anyway, but usually that also means a fairly lower return. So it's saying your target asset allocation. They're saying what we think a conservative risk profile looks like. And this is based on the benchmarks that are out there. And it breaks down how there's still going to be some equities, some exposure to Australian shares and also international equities. And that's going to give us the capital growth, so the actual increase in value, whereas we'll rely upon the fixed interest, which is in my case for conservative 50%, cash is 21%, and it still has exposure to property. And if I go through here, it uses the portfolio manager health check as well, and it's saying that, Tom, you know, your existing allocation was all cash, 100%. And what you should be in is on the left-hand side here. And you can see how overweight and underweight you are. So obviously I don't really match the conservative, how I currently stand with just my cash, but this will help me to reach that particular risk profile. Now it goes through and talks about the different action that's required. And it gives you a very straightforward, you need to, reduce the amount of cash allocation and rebalance it. And that's, fairly straightforward. If you're someone who wants to do this yourself, you could use this and then perhaps go out and purchase ETFs or shares to give you that exposure. Obviously, in our case, what we would say is that we've got the conservative portfolio that's set up and it would match you into those allocations. Now, the other thing too is you've probably done your own statement of advice and you'll have different outcomes to me. You might have a high growth, you might have a balanced. It's all depending on the inputs that you gave, the actual statement of advice quiz, which makes sense. So it's going to go now and tell me if I were to rebalance and get myself into the conservative type profile, obviously it would match up, which is of course common sense. And now it's giving me an idea of the risk versus the return and prior to actually going ahead and doing this. So it's showing me here that my cash allocation, on the left-hand side, it says 0.97 negative years in 20 years. And that's like a standard risk measurement that's used. And what that means is that if I was to just be invested in cash for 20 years, statistically speaking, I would experience nearly one negative year in the 20 years. Now, I don't know when that's going to happen. I don't know if it's going to be the case that I have one negative year and then another negative year after that. I also don't know how big the negative year could be. It could be a negative 0.002%, or it could be negative 10%. But it tries to give you some kind of standard risk. A lot of it's based on statistics. But on the right-hand side here, it says, if I had have stuck in the cash for a period of 5 years, the average return is about 1.7% per year for each of those 5 years. And obviously it goes down, and it's just trying to give you an idea of, based on the historical performance, and we can't always base our future performance on past performance, but it can give us more information where we can make decisions. If we go down a bit further, it's saying here now, if you go ahead with the conservative, it does put me into a lower to medium risk, but that's what I need to do in terms of my situation, because I'm wanting to get a bit more growth than what I would just in cash. I need some capital exposure to those equities in Australia and overseas, which have had some really good growth, particularly in the US markets. You look at some of the big companies that have taken off over the last 10 years easily. Amazon, Nvidia as well. Having exposure to those, having international exposure, will help my portfolio give a better return, but at the cost of a little bit more risk, obviously. Now I'm going to go down and it'll go through and talk about the actual risks of the advice that we're giving. There's no cost for these plans. They're all generated for you free of cost. The product fees, which we've spoken about before, it's going to try and give me an estimate. So let's just say that if I had my $93,000 and I took it and I said, yes, I want to choose the InvestSMART conservative portfolio, and that's a diversified portfolio. I put my 93,000 in. The management fee that I would pay is 0.55% per year. And that would be about $512. And what you're doing with that is you're paying that money, and InvestSMART and its team of investment managers and investment committee, they're keeping a watchful eye over it for you. So they're rebalancing when they need to. They're making sure that when you make those contributions, which in my case, I said I'm going to put $600 per month, and I can set that up on a regular contribution, have it direct debited out of my account, or send money whenever I want, no problems. But what the InvestSMART team does is when it comes, they make sure that they send it to the right area and rebalance if they need to. They make sure that any dividends or income, such as interest, savings, or anything else that's generated by the portfolio is either reinvested back into the portfolio or it actually is paid out to a bank account for you. The brokerage. So like I said, we open up a brokerage account for you, and that means that you own the stocks, the ETFs that are inside, and there's brokerage, but we've managed to get institutional pricing. It's very, very low cost. And even you can see the estimate there. In order to set up my account for the first time, $93,000 worth of ETFs, my brokerage is estimated to be about $41. And that's buying, I'll show you some of the portfolios soon, but that's buying about 5 to 7 ETFs. The other thing too is the indirect costs. Now, ETFs, when we buy them, companies like BlackRock and VanEck and BetaShares, they all charge their own management fee inside the ETF. They don't take that fee out of your brokerage account or out of your bank account. They just make little adjustments inside the ETF. And they're going to charge you that indirect fee, whether you do this yourself through your own brokerage account like CommBank or NabTrade, or if you decide to go down this route with InvestSMART and open up a portfolio. So it goes through and talks about all those fees, which is very important. Fees matter a lot because they can make a lot of difference in the long term. We disclose, obviously, our information. We also recommend you should read the product disclosure statement because that covers everything about this product. It's very important. There's the financial services guide that's there as well. And it's talking about if you decide to go ahead, how to do that. And that's gotten us to the end of the actual statement of advice itself. So what I'll do now is I'll just go back and run you through the fees, just to give you a better idea of what I was talking about. So the management fees are capped, but they're 0.55% per annum under $100,000. So the best way to say that is like $55 per year for every $10,000 invested. But as soon as you get to $100,000 invested, that management fee stops growing. The brokerage fee, here's detail. It's $4.40 per trade. So buy, that's one trade, and sell, that's another trade, or 0.044% of the value of that trade. There's the indirect costs, and they range from 0.09% to 0.3% per annum. And that's regardless if you hold those ETFs through InvestSMART or if you decide to hold them yourself. Now, our investment committee is a bit of a who's who, and they meet every quarter and they decide whether or not the benchmark is being followed, is being tracked. And you can see Paul Clitheroe, he's also our chairman. Effie Zahos, she's one of our directors. Alan Kohler, Ron Hodge, our managing director, and Alistair Davidson, who's the head of funds management. Obviously, the statement of advice is going to recommend, based on the information you give it, a different portfolio to invest in. And I can hover over the word invest here, and you can see all of the investment portfolios, diversified or single asset class. But if I scroll down, I can get much more detail. Now, I've spoken a lot about the conservative because that was something that matched or suited me based on my inputs to the statement of advice. But let's choose the InvestSMART growth. Now, all of these you can see here, it says 75% performance, and that's the average performance since inception. And the inception for these is about 10 years. So we reached the 10-year anniversary, which was a really good sign of how these perform over the long term. There's also an estimated income of 3.3% per annum, and that's forward looking. That's what we think that your portfolio, it should be able to generate in income. So that's distributions from the ETFs, but also interest and things like that. You can see they're all different. 3.9% performance, 5.7, 7.5, 9.1. There's also the ethical growth that's down here as well. So I'm going to click on Learn More under InvestSMART Growth Portfolio, and it will give us a lot more of the core information that helps us make this decision. Now, there was a really good question that came through prior to the webinar, and it was, what is the minimum investment amount? Is it $10,000? And that's the default. Yes, it is. So it's $10,000 to open up an InvestSMART diversified portfolio. That's applied from conservative, high growth, and the ethical growth. However, we do have a special product called Fund Later, and that allows you to actually open up a growth, ethical growth, or high growth portfolio with only $4,000 up front. So you come to us and you've got $4,000, and InvestSMART through Fund Later actually lends you $6,000. And you've got 20 months then to repay. You pay $325 per month over 20 months. There's $300 that pays off the loan and a $25 admin fee. And if you want to pay it off sooner, that's no problems. That can help reduce those repayments, or reduce the fees, I should say. The thing is, though, once you go through this, you're immediately invested into your chosen portfolio. So that means that instead of having to wait however long it's going to take in order for you to save up that minimum investment amount, the $10,000, you can choose this route and it'll get you invested today. And then you can make those repayments over 20 months. The other thing too is that this is called a non-recourse loan. So it's not a margin loan. Margin loans leave you open to margin calls, for example, where they say, your investments have dropped below this amount, you need to put money in immediately or we're going to sell everything. It's not a margin loan, so there's no margin calls. It's a non-recourse loan. And what that means is that, obviously if you're about to do this, there's confidence in the portfolios, confidence in your ability to repay 20 times over the 20 months. And if for some reason you can't do it, or if you change your mind and you decide, I don't want to be in this anymore, if you decide to step away, we sell the portfolio on your behalf. And if there's any difference, let's just say that the market dropped and you owed InvestSMART $1,000. Because it's non-recourse, it means that InvestSMART carries that risk. So they don't come after you and say, you owe us $1,000. The amount of your actual assets, they're used to cover off the remaining loan amount, and InvestSMART carries the risk of any difference. So it's available for 3 different portfolios: the growth, high growth, ethical growth. The thing is, if you do the statement of advice, it won't recommend the Fund Later because that's a different mechanism. So you can always come back to it where I was showing you before, and you can choose the different portfolios. And you can do that whenever you wanted to. If I go down to the performance here, looking at the growth portfolio, this is the difference that the capped fee or low fee that we've got makes. So we've got our color here in the salmon type pink color, and the average of our peer funds is in the blue. And you can see that 10 years ago, they started fairly close. And then over time, that gap's gotten wider and wider. And that's because of the low fee and capped fee benefit. So that means it just stays in your pocket, in your investment account, and gets reinvested and compounds over time. There's the table here as well, showing you the different returns, and we break them down. We've got the 10-year column now, which is fantastic. So it tells us over that period what kind of return. So if we look at the total return, which is of course the capital, the increase in value, plus the income that's paid out, we averaged 7% per year over the last 10 years. And when we compare that to our peers, the peers is 4.75% per annum, which is about, we're outperforming them. The excess is 2.27%. I'll go down a bit further because in the key facts, there's a lot of information here that's quite helpful. The fees, of course, the asset allocations. So all the different risk profiles carry different asset allocations that are in line with that risk type, that risk profile. You'll see here in the growth, as you'd expect, we've got a longer time frame, which is very important. I'll just show you the time frame. It's 5+ years for a growth. And it means that because of that longer runway, we can take on more exposure to asset classes like equities and also international equities that will likely give us a better return in terms of capital growth. So they'll go up in value. They'll also pay out distributions or dividends. But we can show all of them have different percentages in terms of their asset allocation. On the right hand side, you can see the actual ETFs we purchase for you. So you can Google any one of these and get even more information, even find out what their indirect fee is, for example, and it will tell you the returns. But we use ETFs in order to get you the exposure inside our diversified portfolios. So one of the best ways I like to explain it, it's diversified, different asset classes, but instead of us just using one ETF provider, like we just don't use all beta shares, we actually spread that risk again, and we use the best ETFs based on our InvestSMART star profile. So we make sure that we choose ones that are very liquid, easy to buy and sell, have a lower fee, and we've come up with this holding here. So we diversify you amongst all of the ETF providers as well. And that's a key difference when you look at some other providers who offer their own diversified portfolios. They'll have you just in their product, for example. So that's one thing that might help. But you can see here indirectly the underlying holdings in those ETFs, companies like Commonwealth Bank, Nvidia, Goodman Group, CSL, etc. So that gets you exposure to all of those different companies. What I'll do is I'll just show you how, if you thought, oh, gee, I don't remember how to actually get invested through my statement of advice. If you go up to this little icon here, once you've logged in, go down to My Advice. And you can see here, I've had a little bit of a play. I've even started my second SOA for a second home. So I'm getting quite adventurous already. But you can see here that I've got 2 that have been completed. If I wanted to click Invest Now or download or delete, I can do that. If I click Invest Now, it'll start the process for me and get me invested into my chosen portfolio. So we'll open up for questions and answers if you've got any. We obviously had that question before about the minimum investment amount, and that was of course $10,000, but you can use the fund later, which is able to be used for the InvestSMART growth, InvestSMART ethical growth, and the InvestSMART high growth, not for the conservative or the balanced. And of course, if you wanted to use fund later, you would have to just go through the actual website still and open up the portfolio through that way. The statement of advice, it will recommend those portfolios, but you'll just have to make sure you choose it during that path. So I've got a couple of questions here, such as, can I change my statement of advice? Yes, you can. As you could see before, I had 3 different types. I had 1 on the go, about to be finished, and I had 2 that I've done already. And that's quite normal because you'll have different goals and different timeframes. And that's the whole point. Our portfolios are designed so you can do that. You can have different PMAs, portfolio management accounts, set up. And that way, at least, You can have one targeted towards, say, owning a home, or one targeted for children's school, like the actual cost of going to school. So you can have numerous ones on the go. The one thing you can't do is you can't go back into the SOA and adjust it. And that's because, like I said, they're only good for about a month in terms of that's how long we recommend it stays active and you act on that investment decision. So it's very easy to go back in and redo a brand new one so it's up to date. Can I invest a different amount? You can always adjust your contributions. So I said $600 I was going to do for my first home SOA, statement of advice. But of course, you can change your contributions. You can make more, you can make less. Obviously, if you make less and contribute less per month, it will obviously affect your statement of advice. So it's probably good to go back and redo that statement of advice and just give you some more information. Is this right for me? And that's a question we get asked a lot at InvestSMART, and we can't sit there and give you any personal advice. So we can't say, this is going to suit you, Jim, or this is going to suit you, Sue. We can't do that, unfortunately. The closest that we can obviously get is the statement of advice that we've got for free. And it at least gives you an idea of what you could investigate further and perhaps go down the path with. That being said, we're always here to help. And you can reach out to us by calling us. There's a live chat feature on the website staffed by real humans, Monday to Friday, 9 a.m. to 5 p.m. Sydney, Melbourne time. You can always email us at invest@invest@investsmart.com.au. There's even an opportunity to book a call. So if you ever want to book a call, I'll show you exactly where that is as well. If you were to go on the website, and this is the live chat feature that is here, so you can ask questions, and it'll even take you to the help center in case you've got questions that can be covered off there. And there we go. If something's popped up to make an appointment, but if I scroll down to the footer to the where here to help, I can schedule a call, and that will allow me to schedule a call with someone at InvestSMART, and you can ask questions to your heart's content. So we've reached the end of the statement of advice webinar. We're going to do more and more of these. Be sure to reach out to us if you've got feedback or even if you've got any other questions. We're here to help. Now it's up to you to take that next step and put all of your plans and your information into action and get invested and start your journey. I'm Tom Wilson. Thank you for joining us, and we'll see you next time.